Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into today's Q&A episode. So the first question is from Amelia and Ivan. Ivan's 45, Amelia's 36, working full-time living in Perth. Ivan earns 150 grand plus 10% bonus. Amelia earns 142. They've got two investment properties worth about 1.4 in total with about $550,000 of debt against them. And they've got their primary place of residence, their home, worth $1.5 million with $1.2 million of debt against them. So, the first observation there is that it's not optimal, is it, when you've got much lower proportion of debt on investment properties and much higher on the home, although it's not unusual, it's circumstantial. Super balances about 250 and 220. And both contribute to the maximums, $35,000 of annual savings. They go on to say that we've got three strategies we're thinking and wondering which could be the best way to go. Also, we're thinking of having one child in the next year, roughly 1 to 2 years off work, 3 years paid maternity leave. Okay, first one is hold the two investment properties for another 7 years and sell to do a $700,000 reno to the home and pay down debt. Sell one of the investment properties. This is the one that's worth $800 with $350, so probably the lowest geared asset, and replace it with $1 million investment property, or buy another property, so a third investment property, and keep all three for 5 years. Save the rental income and then sell to pay for the reno. So the first thing, guys, you've got to really think about is returns. How long have you owned these assets for? Are they returning well? Like, what's the growth been like? What's the income cash flow profile like? Although I could probably guess that or estimate the cash flow from the rents and the debt that you've told me. But really the missing picture is the capital growth. And then also the other thing I always ask when I meet new prospective clients is, which ones are you happy with and which ones aren't you happy with? Because again, on paper, there's a few bits to analysing property. You can do the on-paper analysis, which is really just looking at the numbers, past growth, and all the other indicators like that. Then there's your experiences with the property, because you could have a property that's just a constant pain in the neck with additional maintenance, or there might be something going on next door, or, there's these sorts of things that you only get through experience, not on a spreadsheet. And then it's the local area knowledge sort of stuff, which we would normally divert or revert to a buyer's agent that we trust, just to say, hey, what do you think about this property, this location? Because again, there could be nuances that don't really fully reflect in the spreadsheet or the numbers or the analysis. So really, that's what we really need to do to work out, okay, what are we going to do? Because the key question we need to ask ourselves here is, okay, we're going to do a reno in the future. We know we need $700,000 for that. We're either going to have to save that cash flow, sell an asset, or borrow the $700,000. We've got to find it from somewhere, right? So therefore, the key question we need to ask then, of these two investment properties that we hold, what contribution will they be making towards this $700,000? Now, if we want to do the reno in 5 to 7 years, something like that, we don't necessarily need all the money in 5 to 7 years, because we could say, okay, in 5 to 7 years, we're going to go borrow another 700 grand, but we just want an exit strategy. So how are we going to repay that in, say, 10 years or 15 years, whatever the timeline might be? So for instance, you might go, well, let's hang on to these properties for a lot longer, so another decade or beyond, and carry that higher non-tax deductible debt on the hope, or maybe a little bit more than the hope, on the plan that these assets are going to deliver a lot of compounding capital growth, and that's what's going to help me repay the home loan. The other thing you got to think about is the relative risk of doing that. So, you're always going to pay 6-ish% on your home loan. Of course, interest rates change. It's going to be either higher or lower than that at times, but let's just say roughly that's a risk-free cost, as in that cost is always going to be there. What will the property market return? Of course, as we've seen over the last few months, well, this calendar year to date, returns are uncertain. So there's that element as well. So I don't really have enough information to be able to answer your question between those three options. Buying another investment property or replacing an investment property Of course, thanks to the Albanese government, that's off the table now, isn't it? I mean, because you're not going to get the negative gearing, so you're sort of stuck with the assets that you've got. So at least, at least that decision's been made for you. But I think you probably need to draw a conclusion or reach a conclusion of what you think the future returns from the property will be. As I said, you've got your risk-free cost at 6%, so you're going to need to earn a total return north of, say, 9% to deal with the tax drag. Of course, you've got to pay tax on investment returns and then also being rewarded for that. But I probably wouldn't make that decision now. And I'd probably say, make the decision over the next maybe 12 to 24 months. Let's see what happens with these tax changes because we don't have a normal market at the moment. Let's see what happens. And over the next couple of years, I think we'll be able to, get a better sense of the direction that any of these tax changes might be making. And if negative gearing is reinstated, for instance, or some of these taxation changes don't survive, then I think we'll get a kick in the market. And then that way you can kind of see or measure how's my property doing relative to the market. But I think the answer right at the minute is don't do anything, don't make any changes, hang on to the 2 investment properties, put as much cash flow as you possibly can into the home loan, and then cross your fingers and hope that, the property market starts to see some positive signs because all we've seen is, tighter rental regulations in many states of Australia. We've seen higher interest rates. Now we're seeing higher taxes. We've seen higher land taxes, particularly in Victoria, and other states have been, particularly eastern seaboard states, have just been just as bad. So we've had a lot of bad news over the last number of years. Let's cross our fingers, hope for some good news. So not overly helpful advice, Amelia and Ivan, but at least that's what I'd be doing if I was in your situation. Okay, next question from anonymous listener. Hey guys, only started listening to your podcast recently. Appreciate it. My question, asking for advice, what we can do to play the long game at my age, which is something I've always been thinking about. I'm 26, my partner's 25, combined savings about 60 grand, no property, work in the real estate market in Sydney, looking to buy a villa or townhouse as a first property to live in because affordability for a house just isn't there yet. And then we'll eventually sell and upsize later on. My income can obviously increase dramatically down the track, but I like working off certainty. I believe my partner and I earn a combined $150,000 a year, save about $2,000 a month, and put $500 towards an S&P, and I think it's NDQ, which is a NASDAQ ETF, for it to compound until retirement. What else would you do to set ourselves up? I mean, I think I've spoken about this before, but really you're starting out, you're young, you've got a very low asset base, relative speaking to where you need to be, obviously. Of course, you're in your mid-20s, of course, you can have a low asset base. So, of course, you need to build that asset base as fast as possible. The best way to do that is assets that provide most of their return in capital growth and very little income. Property has tended to be the best way to go in regards to that, still can be, especially, if you, as I spoke about last week, which was live vesting strategy is, investing in your home. When you're young, it's really important to get the growth as soon as you possibly can, but also we can't predict what markets will do in the short term. So I say play the long game in terms of buy in the right market, a market that in 10 years and 20 years from now will be even more popular and more sought after, which I think is a little bit of an easier thing to do in Sydney, just because it's, landlocked with water and national parks. So you've got the natural impact of very tight supply in terms of land supply and growing and excessive demand. So you don't cut any corners there, but where you can start thinking a little bit shorter term is what can you do to the property to enhance its value? And I think it's even more important in markets like we're in today to try and manufacture as much growth as you can rather than just waiting on, the market itself to drive that growth. And then I guess over the next, couple of years, the market could be relatively subdued. So I think it's about, so in terms of there will maybe not be as many other buyers to compete with. I mean, the challenge is that the market will probably lock up and there won't be a lot of supply either. But I guess for someone that's, really focused on create long-term income, wealth, I should say, and that is willing to do a bit of hard work to renovate, improve property to generate value, there could be good opportunities over the next couple of years. And I guess it's just being about out there in the market because you're not going to see them if you're not looking, and having a combination of patience, but a willingness to make a decision and act on a good opportunity quickly. You need both of those things. So, don't just jump at any opportunity, but if something arises, then you might be able to buy really well. I have in the past, bought property. I think I've spoken about this on the podcast before. In the midst of the GFC, I bought a substantial property in Melbourne. So there's times where there's heightened uncertainty. It can create opportunities. And since you're buying for an owner-occupier purpose, you don't need to worry about negative gearing so much and capital gains tax. And really, that's going to be the best way to build wealth. It's challenging, when you first start out, but, it sounds like you're focused on investing. But so I don't really have any tips other than spend as little as you possibly can, maximize your borrowing capacity. Challenging to do when interest rates have increased 3 times already this year, but maximize your borrowing capacity wherever you can. And, do the best with your money. It's not very helpful advice, but unfortunately, it's the only advice I've got. And, I think if you can take that long-term view, hopefully you're not too spooked about all the changes and the negativity around property because, 5 years from now, we could be looking back at 2026 and going, well, it was actually a pretty good time to buy. I suspect we might. But of course, who knows? I don't know any more than anyone else really, but not really great advice, I admit. There's no secret or magic bullets here. It's really just about playing that long game, finding an asset that you can manufacture value in, renovate, improve the property, nothing structural. And in the long run, that's the best thing you can do. You can only worry about the things you can control. You can control where you're putting your money, and you can control, how much opportunity you give that asset to grow. Anyway, all the best. Okay, next question is from Freddie, and a really interesting one about inflation and how to deal with inflation in financial modelling. Inflation is the top of my mind for me and many others these days. Could you please explain how inflation should be addressed in any modelling, please? For example, on our expenses, I assume we should be increasing these each year for inflation. However, on the income side, the returns you often talk about, like 7% per annum for shares, already, I believe, include inflation. Therefore, the overall net income less expenses, that results in a particular year will be in dollar terms for that particular year. However, let's say I want to measure investable assets as a measure of how we track over time. For example, what will my investable assets be in 2032 compared to 2025? Should the investable assets in 2035 be adjusted into 2025 dollars? Okay. I shouldn't have read the question because it starts to get a bit confusing, which is not a criticism of Freddie. I understand exactly what Freddie's means and is asking. It's just a bit confusing. But it's a really good point and it's worth really talking about. And what I'll do is I'll share our approach and the rationale for that, and you can then sort of measure how you want to deal with that. Inflation absolutely needs to be considered in an investment strategy because the time value of money is substantial, maybe less so from year to year, but certainly from decade to decade and over a multi-decade period of time. If you're aiming for $100,000 in today's money to spend and you're going to retire in 30 years' time, it might be like the inflation might eat away at it might be worth $60,000 by then, right? And of course, you have a different standard of living for 60 versus 100,000. So we want to be consistent in our modeling with the inflation. So we want to really think about, we include nominal returns, which include inflation. So 7% includes inflation, which is really, if we assume inflation is 3%, which is what we do, then it's really 4% plus inflation is the return. Same with property returns. If we assume 6.5% capital growth, what we're really doing is we're assuming that the growth is 3.5% above inflation. And so if inflation's lower, then our expenses will increase at a slower rate, our income increases at a slower rate. It kind of all nets it out. So as long as your long-term inflation assumption is correct and you've treated it consistently in the model, then, inflation is less of a risk in that regard. There's a couple of differences here. Sometimes we won't inflate income. So depending on the occupation and the employer, sometimes clients just feel like, actually, I don't mind assuming that inflation will eat away at my income. So in real terms, my income is declining because it's not keeping up with inflation. So sometimes we won't do that. And so if someone's earning $250,000, we'll just drag that across, in Excel for all the, next 20 years, even though we know $250,000 in 20 years' time is a pay decrease. Otherwise, we will just include consistent level of inflation, so 3%, even though the wage inflation rate's about 4, closer to 4 in Australia. If we are expecting income increases, particularly if you've got younger clients, I think that's okay to sort of build in there. You want to be conservative about it. With respect to expenses, depends on the nature of expenses. We would certainly inflate expenses, general living expenses, at least by 3%, so inflation. Things like private school fees, for example, we would inflate by 5% per annum, just because historically that's what they've done. Rental income, we inflate by around 4.2%. That's been the long-term average rate of change in rental income. So that means that the yield, if we're assuming the capital growth rate is 6.5%, but income's only going up by 4.5%, the yield relative to the market value is compressing, is reducing over time. But we're okay with that. We're satisfied with that as an underlying assumption. And then what we do is we calculate net investment assets. So we exclude anything, the home loan, any offset cash in the offset account attached to the home loan, and any other personal use assets, contents, cars, these sorts of things. So excluding those items, we look at or calculate net investment assets, the assets that ultimately you need to fund retirement, and then we discount them back in today's dollars. So for example, if we model out and say, okay, we're going to do these 10 different strategies for this client, their net investment assets stay $1 million. In 20 years' time, we project those net investment assets to be $30 million, right? It's unrelatable, but if we discount it back in today's dollars, it might be 15 million or whatever. I'm just throwing numbers out there. But I think it's good to discount it back in today's dollars, mainly to give you a good sense of whether you're on track. And so when we do some financial modeling, if we work out, or if we do all these different things with this client, they're going to have $20 million in terms of net wealth in today's dollars. Well, we know that it's a no-brainer, right? They're going to be fine. There's going to be a strategy there, whether it's all the assets that we've predicted that we're going to keep moving forward or not, or we sell everything, pay all the tax, doesn't really matter. 20 million is more than enough for most people. So that's the reason why we discount it, is to make the number more relatable today, and also as a bit of a sanity check to make sure, well, in today's dollars, if someone walked into the office and they had a net wealth of X, would we feel comfortable about building a strategy for them? And if that number's less than $1 million, for instance, and we've got a husband and wife or two spouses, that's probably not going to be enough money. So, we can kind of sanity check that amount. And I guess finally, for any other, so we want the inflation in investment returns and income and expenses. I guess anything that if you've got some unique expenses or unique income that's going to grow by more or less than inflation, I guess you can treat that separately as well. The reality is that inflation probably over a very long period of time can't exceed wage growth. And when you look at Australia, I think the reasonable assumption is, general inflation's 3% and wage growth is probably going to be around 4% at an aggregate level. But, you might want to adjust those assumptions a little bit to deal with any risks that are specific to your situation, to make sure you feel most comfortable. The one that's really sensitive, though I should point out that actually Cam and I were talking about last week, is how much you assume your rental income is going to increase by. So sometimes I've seen people go, okay, I'm going to get 7% growth and I expect a 3% rental yield. And so they'll apply the 7% growth each year and then multiply that by 3% to give them the rental income. But that sort of suggests that obviously that rental income is going to grow by 7% in line with the capital growth because you've linked it to the asset. I'd just be careful about that. I don't think rental incomes can grow more than general wage growth because, and this goes to the debate that's happening at the moment. If you restrict investors in established properties, rents are going to go through the roof. Well, they won't. They probably won't. They will increase, but they probably won't because renters only have a certain amount of money to be able to pay for rent, and so it's not like you can charge someone $600 a week and then increase it to $1,200 a week down the track, because they just can't. They'll just go, well, I can't afford that, right? So they're not going to be perfectly elastic. rents. And so you just want to be careful of that. So you don't want to underpitch it, because then your model will suggest that the property is going to be negative cash flow for 30 years. That's probably unlikely from what I've seen. But also you don't want to be over exuberant about rental income increases as well, because then your model's going to say, oh, look, it's going to be positive cash flow in 8 years' time. And also I think that's not realistic. So I tend to like to see the property starting to become positive cash flow after about 14 to 18 years of ownership, somewhere in that. And that to me feels about right from what I've observed personally and professionally with regard to, modeling property. But really good question there, Freddie, about inflation and some of the assumptions that we utilize, because it's a very important thing, right? We want to make sure that we're being realistic but conservative, because ultimately when we're doing some financial modeling, we want to work out that if we stick to this plan for the next 20 years, we're not going to regret it. And, you can come up with any assumptions to make the numbers work, but you want assumptions that are, evidence-based, that are reliable, that are realistic but conservative. And we're better off to do those numbers and in that way and find out, no, in fact, this strategy is not going to work, than waste 20 years trying to pursue that strategy. So that's why it's such an important question and always good to talk about. Okay, next question is from Dane. Dane's in Perth. He's 40, earns 150 grand. Wife's 38, earns 21,000. Doing some casual work, but expected to increase once the kids go to school. 2 kids, 6 and 3. Home in Perth worth 1.4 with 520,000 in the mortgage, as a mortgage balance, I should say, with 370,000 in the offset. So what does it give us? About $150,000 of net debt. Super, 265,000, some shares, 2.5 grand, not much. The goals to build wealth long term, not necessarily early retirement, potentially assist kids down the track, and have assets, for financial security later in life, as in aged care and so forth. Dane's been looking at investing in property in Melbourne, probably not so much now given the taxation changes, but a little bit uncertain around interest rates. So we received this question end of March. So I imagine maybe Dane hasn't purchased something in Melbourne yet. And he went 4 questions. Dane's got 4 questions. Am I in position to buy an investment property yet, or should I focus elsewhere? Number 2 is, should I prioritize using available cash, the money in offsets, before looking at property, so investing that cash? Number 3, is there any benefit at this stage in setting up a trust or other structures? And number 4 is, how would you think about risk here, particularly if interest rates were to increase significantly? Okay, Dane, they're all really great questions. Now, apart from the fact that obviously with negative gearing being quarantined after 1 July 27, that I don't think, as I've explained the last couple of weeks, I don't think investing in established property is the way to go. But what I've said is maintain a bit of optionality there. So don't burn all your borrowing capacity at this stage. If borrowing to invest in property, it probably is, I'm not saying right now, but certainly at some point over the next decade is probably a good thing for you to do, subject to cash flow, then let's not close the door on that just yet. Let's see what happens to these taxation changes. But I think in the interim, what you haven't mentioned there in your brief is cash flow. So I don't know, how much free cash flow you've got, if any, but that would be the thing that I'd be thinking about. You've got $370,000 in the offset accounts. That tells me you're pretty good at managing cash flow, and you probably have some surplus cash flow. The other thing too is your youngest child is 3. So that tells me that in a few years' time, the kids are going to go to school, and maybe your wife has greater capacity to return to work and earn a little bit more income. And that'll obviously help your cash flow position as well. But the $370,000 isn't really working very hard for you. I mean, it is in terms of reducing interest, but what it's doing is it's absorbing some of that borrowing capacity that you've got, and that borrowing capacity isn't really working that hard for you. But so I probably would have said, now it's a bit tight to go and buy an investment property given your circumstances at the moment, in that, if you're going to do it, you do it well. Doing it well means borrowing a substantial amount of money, probably exhausting all your borrowing capacity, and that's going to put you in a situation where you're going to be quite sensitive to interest rate increases at a time when your family income's lower than usual and your expenses are higher than usual, with maybe a bit of daycare, but other expenses that go along with having a young family. So I would think maybe building out that share portfolio a little bit in your wife's name might be something good to do. So you would do that using debt recycling. So, get a separate investment loan, leave all the cash in the home loan offset. Definitely don't invest that cash because we want to reduce non-tax deductible debt first. But I don't think having $370,000 of cash is a good idea either. So maybe what you could do is over the next, 12 to 24 months is invest $5,000 to $10,000 of that cash notionally. You're not going to invest the cash, but notionally into the share market. And so the way you'd do that is you'd go to the bank and say, can you give me an investment loan for say 150? And then you would draw $5,000 to $10,000 a month and put it into the share market. And at least then you're getting some growth assets working for you. You can negatively gear those growth assets actually. So you'd put the investment loan, they might want you to have it as a joint loan, that's fine. But you'd put those shares in your name probably, so you get that negative gearing benefit. Invest it in the international share market I've spoken about, or a diversified global share ETF. That'd be a good idea. Low income, more growth, better negative gearing benefits. But at least then you're only utilizing say $120,000 of your borrowing capacity. So it's not going to move the dial in terms of eliminate your ability to invest in property down the track. But at least you're doing something. And yes, it's giving rise to more debt, but you've only got $150,000 of net debt now. And at least then you're going to have $150,000 of net home loan debt, and you have $150,000 of investment debt. Again, you're doing something, but you're not moving the dial too much in terms of exposing too much risk. So I think that's what I would do for the next 12 to 24 months. Let's see how these changes pan out, and no doubt I'll be talking about it. And as we get closer to 2028, the next election, depending on what direction we're going in, I'll revisit all this advice. It's not advice, it's information only, of course, but you know what I'm saying. So, but that's the approach I would take. So at least then you can, pivot down the track. You're doing something rather than nothing, but you are still building out those growth assets. And CBUS, be careful with that. I mean, I've got a super report coming out next week. It's a really detailed superannuation report. I used to produce just a blog on it. So the blog has turned into I think 28 pages of report. A really important decision. You don't need to read it all. You just need to read the bits that are going to be important to you. But I've got a sort of decision flowchart or matrix that helps people kind of review their super fund. Very important decision. I would do that as well, Dane, but all the best. And thanks for submitting your question. Okay, final question for today is from Gus. He's 46, wife is 43, 3 kids, 14, 16, 17. They currently have 115 grand in a family trust in the share market and about 132 in Gus's name that they're gradually shifting into the family trust. Live in WA rent free and don't think, and we'll probably be doing that for the next 4 years at least. Have an investment property worth about 900 with 465,000 in debt with 175 in offset. So let's just call it 900 with $300,000 of lending against it. So that'd be pretty much positive cash flow. No home and probably won't need one until retirement, which is 10 years time. So you'd like to retire at 56 before we can access super. He earns 180 and wife earns 125. Super is 480 plus 190 and they've been sacrificing into super. They've got a spare investable cash flow about $3,700 a month. And his preference would to invest in the share market ungeared, but he's considering whether to buy an investment property in Melbourne would be a better idea given he's got a bit of time for gearing, and then he thinks, well, we can keep investing in the share market and super for the next 10 years and we'll probably have enough money. Oh, the big challenge here is the home. How much is a home going to cost you in 10 years' time? Because you're going to have to find that money on an after-tax basis, which means you're going to have to sell some investments to be able to fund that, which is always a concern. So whenever I have a client that doesn't have a primary place of residence, we are always thinking as a team about how we're going to fund that. Because if we turn around one day and go, okay, now I want a home, and then we're going to sell, a couple of $1 million of investments, that's not great from a taxation perspective to kind of do in one hit. So it's pretty inefficient. So, thinking through it, you also wouldn't want to take it out of super as well. So you've got nearly 700,000 in super. Over the next 10 years, let's hope it gets to 1.5 to 2 million, probably with some pretty aggressive contributions, actually probably going to get close to $2 million. $10,000. So that's a decent nest egg. Let's call that enough to fund retirement, which it probably will be. And I'm just making some assumptions here. So really what you need to do is generate enough, and the investment property, let's call that the kind of fallback position. So then really what you need to do over the next 10 years is generate enough wealth so that you can buy a family home. I guess the question would be is, do you know where you want to live in 10 years' time, where you want to retire to? And what level of confidence do you have around that location and property type? So, if you said to me, Stuart, 100% I want to live in this type of property in this location, and there's no chance of me ever changing my mind, then I'd think about buying that property today. With a bit of leverage, you've got a good income, you can at least then peg yourself in at that sort of price point. Now, I wouldn't do that right. Well, you could actually do that right now because you don't have a primary place of residence. So you could actually go and buy that property, live in it, in inverted commas, for 3 to 6 months, and then treat it as a primary place of residence using the 6-year rule. So you could do that as a strategy decision. But alternatively, if you said to me, Stuart, I have no idea where I want to live, it could be virtually anywhere in Australia, then you don't necessarily want to go out and buy a property today because you might have to sell it in 10 years' time if it ends up being the wrong location or the wrong type of property. As I said to the previous person that wrote in, I wouldn't be buying investment property now either. Gus sent the question at the end of March, so I'm assuming that you haven't already done so. I mean, if you have, well, then the decision's made. But so, look, I think you're right. You don't have a lot of gearing for someone in their early 40s that is still in aggressive wealth accumulation stage. Your property is undergeared. You've got 175,000. Let's just call that your buffer, your living expense buffer. That's fine. Leave it there. But it sounds like you've got some equity in that property that you probably should be utilizing. Now, the question then is, are you confident enough to go and invest that money into the share market in a way that's value aware, using the same sort of, everything I talk about in Wealth by Design, which is out in a couple of weeks' time, by the way. So hopefully, Gus, you can read what I talk about there. But if you felt confident about doing that, then going out and borrowing, 200,000-300,000 and using some gearing to do that wouldn't be a bad idea. The investment property idea, one of the complications with that is the 10-year time horizon. It's not really long enough to own an investment property. It could be if you buy well in Melbourne and Melbourne does well over the next decade. Of course, that could work out okay, but not really a great strategy. I would be really thinking very carefully, especially over the next couple of years, whether you could buy an asset and treat it as your home, from a investment perspective. So as I said, like occupy it and claim the main residence exemption. Yeah, sure, you're not going to get negative gearing benefit, but then you're not going to pay tax either. And you negate the issue of having to sell assets down the track to buy a home. Notwithstanding that, look, I think some level of gearing inside your strategy makes sense. I just don't know whether property is the right way to go, given the taxation changes, but especially really given your time horizon. And maybe the best thing to do is just use the gearing in the family trust and benefit from that gearing, and then you could just treat your investment property notionally as your future home. Kind of, you might have to sell that asset, pay capital gains tax, but hopefully over the next 10 years, your super will do okay, probably enough. It's just then, together with some gearing, can you accumulate enough asset? If you're investing $4,000 a month, maybe you can borrow $4,000 a month, invest $8,000 a month. And will that, if you do that for the next 5 years, then turn the gearing off? Will that be enough to really compound? I don't know. I'd need to spreadsheet and need to model it to see whether that's really going to work and whether you can hit that 10-year time frame. I suspect you'll be able to retire by the time you get to 60, but is 10 years cutting it too fine? I'm not really sure. And this is a good planning opportunity too, by the way, because sometimes we would look at something like this, and if someone had an idea like, this is what my goals are, maybe some feedback from us might be, well, by having such a short time frame, you're actually foregoing what is actually the better strategy, which is maybe to invest in property. I'm not saying using Gus's situation, so let's see if we can tinker with these goals a little bit. It's kind of sounds really strange because, of course, we should let the goals drive the strategy. It's not for us a client should come to us and say, these are my goals. But if those goals are a little bit unrealistic, or we think we can just tinker with them a little bit and push them back a little bit, and then we can then get a better strategy, or what we think is a better strategy, let's do that and make friends with that. And then if everything works out in our favor and the returns actually work out better, or the performance it works out better, then you still might be able to achieve those original goals. But at least you've made friends with maybe not being able to. You've got to be a little bit more flexible on that. This is one of these scenarios, I think, where you probably need to model it and think about it quite carefully. There's not one answer that jumps out at me here. But I would agree that for your age and stage of life, you don't have enough gearing. And to be able to get close to where you want to go, maybe not bang on it, but close to it, you definitely need more gearing. Now, whether that means just a little bit of gearing into the share market now and buy an investment property if the rules change down the track, or whether it's go and buy a future family home now and treat it as your principal place of residence, and then, aggressively repay debt, whether it's something completely different to that, I don't know. And I'm obviously not going to guess either. But so I've probably given you more questions than answers. Sorry about that, Gus, and sorry I can't give you a very direct response. Quite often I can with these questions, but in this situation, it's not really clear or obvious to me. Okay, tomorrow's episode is about cash flow management. 2 parts to it is really automation of cash flow management, so you don't need to rely on discipline. And then I'm going to share a Claude prompt, so how to use AI to do something that would have taken many hours to give you actionable insights to help you automate better. So I've been promising that episode for a while, but I wanted to talk about investing in established property and rent vesting last week. I wanted to talk about those 2 things leading on from the taxation changes first. But anyway, I'll get into that tomorrow. So until then, bye for now. Before I go, my new book, Wealth by Design, is now available for pre-order. Pre-orders matter more than you think. They're used by bookstores and online retailers to decide how many copies of the book to stock. So, as a huge favour to me, if you're considering buying the book, I'd really appreciate it if you pre-ordered it now rather than wait. And the part that I'm most excited about isn't really the book itself, it's the AI companion tool that I've built to go with it. I reckon it's a game changer, and I'd love you to see why. The pre-order links are in the show notes. Thanks a lot.